Hey everybody, JD here with your Rational Trader Market Analysis Daily. In today's video, we're going to break down the mean reversion cash machine trade for this week on Delta Airlines. I thought it would be fun to just take you through kind of the process that I use for setting up these mean reversion cash machine trades. With Delta Airlines reporting earnings on Thursday before the market opens, we have one more day of trading to go before finalizing our trade. This is going to be a spread trade that we're going to make on a credit spread, both on the call side and the put side for Delta Airlines. Now, we won't make the final determination of the strikes to use, but we will be using the Friday expiration options in making this trade. So first, let's take a look at some history over the last 5 years for Delta Airlines. It's interesting to note that over 20 quarters, we've had a positive one-day move after earnings, only six trading events. So six quarterly reports resulted in a one-day move that was positive. 14 of those 20 in the last 5 years were one-day moves to the negative. Now, I don't put a lot of stock in that specific statistic because the past really doesn't represent anything more than a coin flip. But it is insightful just to see the bias from a negative to positive standpoint. And it is a data point that I use to factor in my analysis to make these cash machine mean reversion trades. Looking at the specific data points of one-day returns over the last 5 years, it is also instructive to note last quarter's 23.4% gain after earnings is a massive, massive outlier. Meaning it's to me it's a data point that you can toss out. Now, 2 quarters ago in January, you did have a 9% move after earnings, so that's also interesting. Although not necessarily out of the realm of kind of the norm, what you would expect after Delta reports earnings. The median positive gain, those six times that Delta moved higher, are going to be heavily, heavily influenced by these two data points. So you do have the median positive move of 5.1% to the upside after earnings, one day after earnings. And on the downside, you have, and this is really interesting to me, a minus 2.7% median move to the downside for those 14 quarterly events where Delta's stock price went down the one day after the news was released. So what does that all mean? Again, these are just data points. The max positive gain, again, was at 23.4%. The max negative was minus 9%. And so it's that data that I use to set up my my matrix, if you will, for identifying the strikes that I'm going to use in writing both call and put options, as well as buying back call and options further out of the money so that I protect on the downside and I have defined risk on this particular trade. Now, looking at the reversion to the mean, which is really the power of the magnet for Delta Airlines, the mean price after today's gain of just over 1% is 49.19. We closed at 50.52. That's right about one standard deviations above the mean. Two standard deviations above the mean is 51.77, and two standard deviations below the mean is 46.61. Why is two standard deviations important? Well, again, not only is the mean price a powerful magnet, but 95% of the time a stock is going to trade in between the two standard deviation bands. So all of that data is really super important in setting up the trade. If you look at the current price at 50.52%, I note that the mean price is minus 2.6% below that level. Why is that important? Well, if we go back to the data from the last 20 events, the median negative move is minus 2.7%. So that again fascinates me because it just so happens a move down to the mean price is 2.6% to the downside. And again, you correlate all of this data, it starts forming a pattern again that we can use to set our trade. Two standard deviations below the mean for delta is 46.61. That would be minus 7.7%. And while I would love to write a put option uh, below two standard deviations below the mean, just like we did with Constellation Brands, I'm not going to be able to do that here with Delta because the premiums are not rich enough to justify or at those strikes that are 8% below or below two standard deviations below the mean. So what do I do instead? In this particular case, I again focus on that median move, 1 day move after earnings being minus 2.7%. And if I set a strike price well below that, and in this case, I'm using the 48.50 strike on the option that expires on Friday, then that's 4% lower. Again, that's within or that's greater than what the median expectation would be. So I can write the 48.5 put option for 88 cents. And I set a limit max loss for this trade at $2. So I'm going to buy back a put at the 46.50 strike, and I can do that for 44 cents. And note that that level is 8% below the current price of $50.52. So it's really, again, knowing that the median move 1 day after earnings is minus 2.7%, I'm giving myself lots of cushion to the downside. So I can do buy back a call for 44 cents. I'm sorry, buy the put at 46.50 strike for 44 cents. I write a put at the 48.50 strike, collect 88 cents, and I have a credit put spread then of 44 cents. On the call side, this is where I look at throwing out that outlier event of 23% to the upside. Now, again, that doesn't mean a big upside can't occur here. It absolutely can. And I'm going to protect myself to the downside just in case that event does happen. But 50 0.52 is the current price. Two standard deviations above the mean is 51.77%. That's also 2.7% above the current price. So just like I said, the current price is exactly in the middle of the mean price and two standard deviations above the mean. So for writing a call here, I'm going to use the 52 option, which is even higher than two standard deviations above the mean. And I can do that and collect $1.16. That $52 strike price, by the way, is 2.85% above the current price of $50.52. Now, here's where things get a little bit tricky on the upside. And I debated whether or not I wanted to do this or not, but I'm going to, again, trust the power of the magnet here. The median positive move after earnings is 5.1%, but keep in mind that that includes 23.4% last quarter and 9% to the upside 2 quarters ago. So if I take those out, then my median positive move is below this just about 3% price increase that would be needed to hit this strike price of $52. So at the same time, I can write that call option and collect $1.16. I'm going to give myself, just like the put options, I'm going to give myself $2 of protection, and I'm going to write or I'm going to buy back a call option for 50, with a $54 strike. That's going to cost me about 34 cents. And the net credit then on that spread is 82 cents. The max loss is, um, uh, let's see, what is the max? I'm I'm going to check one thing here really quick just to make sure I did the calculation correctly. I'm going to look at option prices and the 56 call option, just so I was using the right call option is 20. Yeah, I was, let's see, that's 34 cents. And so I was using a call option that was $4, not $2. $4 above the um, strike price that I'm writing. So there's a $4 risk that I have on that call option, not $2. $2 on the put options, $4 on the call options. And to do that, then my net total exposure on the call spread is $3.18. I have a net credit of 82 cents. And on the put option, I have a net credit of 44 cents with a max loss of $1.56. Now, uh, I would trade, and this is in a very large account, by the way. I would look at trading 10 contracts here. And if you trade 10 contracts with this setup of writing a $48.50 put option strike and buying back the 46.50, writing a 52 call, buying back the 56 call. So you've got $4 of exposure there, $2 exposure on the put. Put it all together. If you had 10 contracts, worst case scenario, right? Because you are on the put side and on the call side. If the stock goes up, you're going to be goes above the $56 price after earnings, you're going to collect 100% of the premiums on the put side. That's 10 contracts at 44 cents is $440. You're going to be down, put it all together, $3.18 just on the call side. So net, you end up losing on 10 contracts, max risk of $2,740. And your max upside then is $820 on the if the uh, well, actually, you could collect if the price, let's just say the price goes to the mean, your max upside is $1,260. Okay, so I know I'm going over a lot of material here, but I hope you find this helpful because this is exactly my process in setting up these mean reversion cash machine trades. Now, tomorrow is a new day for Delta. The numbers are going to come in. Differently than they are as I went over it today. I'm going to re-examine the trade in the afternoon, place the trade within the hour of the market closing, keeping in mind that results are going to be before the market opens on Thursday. That's all I have for today, folks. I'll keep you updated on everything over in the Telegram, and I'll be back tomorrow with another video. This is JD. Take care. Have a great day, and we'll see you all next time.